Powers of the Commissioner. The Cooperative Development Authority (CDA) is required to submit a tax incentive report, which shall include information on the income tax, value-added tax, and other tax incentives availed of by cooperatives registered and enjoying incentives under RA 6938 as amended. Such information submitted shall be forwarded to the DOF and shall be included in the database created under the Tax Incentives Management and Transparency Act, TIMTA. 2. After a return has been filed as required under the provision of this code, the Commissioner or his duly authorized representative may authorize the examination of any taxpayer and the assessment of the correct amount of tax, notwithstanding any law requiring the prior authorization of any government agency or instrumentality. 3. In the CIR's exercise of authority to determine zonal values, consultation with competent appraisers, both from the private and public sector, is now mandatory. Prior notice to affected taxpayers is now required. Automatic adjustment shall be implemented once every 3 years. No such adjustment shall be valid unless published in a newspaper of general circulation in the LGU concerned, or in the provincial capital or city or municipality hall, and in 2 other conspicuous public places. The basis of valuation, including the records of consultations done, shall be public records open to the inquiry of any taxpayer. Income tax. New graduated income tax rates on compensation income. Tranche 1, January 1st, 2018 to December 31st, 2022. Not over 250,000, 0%. Over 250,000 to 400,000, 20% of the excess over 250,000. Over 400,000 to 800,000, 30,000 plus 25% of the excess over 400,000. Over 800,000 to 2 million, 130,000 plus 30% of the excess over 800,000. Over 2 million to 8 million, 490,000 plus 32% of the excess over 2 million. Over 8 million, 2 million and 410,000 plus 35% of the excess over 8 million. Tranche 2, January 1st, 2023 onwards. Now over 250,000, 0%. Over 250,000 to 400,000, 15% of the excess over 250,000. Over 400,000 to 800,000, 22,500 plus 20% of the excess over 400,000. Over 800,000 to 2 million, 102,500 and 25% of the excess over 800,000. Over 2 million to 8 million, 402,500 plus 30% of the excess over 2 million. Over 8 million, 2,202,500 plus 35% of the excess over 8 million. Number 2, optional 8% flat tax for self-employed individuals and or professionals in excess of 250,000 in lieu of the graduated income tax rate and percentage tax, tax base, gross sales or gross receipts, and other non-operating income. 3. Final tax rate of capital gains tax not traded in the stock exchange is increased to 15% from 5% and 10%. 4th, tax on sale of shares of stock listed and traded through the stock exchange is now 0.6%. 5. Final withholding tax rate of FCDUs increased from 7.5% to 15%. 6. Sweepstakes and lottery winnings above 10,000 now taxed at 20%. 7. 13-month pay and other bonus threshold increased from 82,000 to 90,000. 8. Health insurance premium and additional exemption for dependents removed, already included in the increased threshold of 250,000 for 0% income tax rate on compensation. 9. Optional standard deduction of 40% may be availed of only once, either by the general professional partnership or the partners comprising the partnership. 10. Installment payment. Second installment shall be on or before October 15 instead of July 15. 11. Tax returns and declarations. Individual returns. Individual whose taxable income does not exceed 250,000 are not required to file ITR. Substituted filing for employees receiving purely compensation income, regardless of amount, from only one employer in the Philippines for the calendar year. The certificate of withholding filed by the employer, duly stamped "Received" by the BIR, shall be tantamount to substituted filing of the ITR. The ITR shall consist of maximum of 4 pages, consisting only of 1 personal profile, 2. Total gross sales, receipts, or income, 3. Allowable deductions, and 4. Taxable income, and 5. Income tax due and payable. Corporate returns. The ITR shall consist of maximum 4 pages, consisting only of 1. Corporate profile, 2. Gross sales, receipts, or income, 3. Allowable deductions, and 4. Income tax due and payable. Individuals receiving self-employment income. Declaration of income tax for self-employed individuals or mixed earners shall now be on or before May 15 of the taxable year instead of April 15. Number 12. Withholding or creditable tax at source shall be 1% to 15% instead of 1% to 32%. 13. Fringe benefits tax FBT is increased to 35% from 32%. State tax. 6% state tax on net estate instead of the graduated rates. Number 2. Deductions. Family home. Value increased to 10 million from 1 million. Barangay certification requirement deleted. Medical expenses, funeral expenses, and costs of testate or intestate proceedings are removed. Other deductible items are retained. Example, claims against the state, transfers for public use, etc. Optional standard deduction increased to 5 million from 1 million. Number 3. Withdrawal from deposit accounts now allowed but subject to 6% final withholding tax. 4. State tax returns shall be filed within 1 year from decedent's death. 5. Installment payment allowed for 2 years without surcharge and interest. 6. Notice of death no longer required to be filed. Donor's tax. Number 1. 6% donor's tax on all donations above 250,000 instead of the graduated rates. Donations to strangers now covered by the regular 6% rate. Number 2. Sale made in the ordinary course of business is no longer subject to donor's tax if the selling price is below the fair market value. 3. Dowries or gifts made on account of marriage are no longer exempt. Value added tax. 1. Coverage is increased to 3 million from 1.5 million. 0 rated sales. Number 2. Sale of goods, supplies, equipment, and fuel to persons engaged in international shipping or international air transport operations is now required to be used for international shipping or air transport operations. 3. Foreign currency denominated sale no longer included. 0 rated services. Number 4. Services rendered to persons engaged in international shipping or international air transport operations, including leases of property for use thereof, are now required to be exclusive for international shipping or air transport operations. Exempt transactions. Number 5. Low-cost housing is no longer exempt, except for socialized housing defined under the UDHA beginning January 1st of 2021. 6. Residential lots are no longer exempt beginning January 1st, 2021. 7. The threshold for exemption of houses and lots and other residential dwellings is now 2 million instead of 2.5, beginning January 1st, 2021. Number 8. Lease of residential unit with 15,000 monthly rental is exempt. 9. Sale of gold to the BSP is now exempt, formerly zero rated. New provisions. 10. Professional instruments belonging to overseas Filipino and their families and descendants who are now residents or citizens of other countries are exempt. 11. Sale or lease of goods and services to senior citizens and PWDs are exempt. 12. Association dues, membership fees, and other assessments collected by homeowners, associations, and condominium corporations are exempt. 13. Sale of drugs and medicines for diabetes, high cholesterol, and hypertension are exempt. 14. Tax-free exchange of properties for shares of stock in a corporation is now exempt. 15. Beginning January 1st, 2023, the filing of quarterly VAT return and payment shall be done within 25 days following the close of each taxable quarter. The payment used to be on a monthly basis. 16. Shift from final to creditable system of withholding of VAT, now at 12% from the previous VAT withholding rate of 5%. 17. Refund for creditable input taxes shall now be within 90 days instead of 120 days. Excise tax. 1. Increased rates for cigarettes, manufactured oils and fuels, mineral products, and automobiles. New provisions. Number 2. Invasive cosmetic procedures subject to 5% tax. Exceptions. Those necessary to ameliorate deformities arising from or directly related to A. Congenital or developmental defect. B. Personal injury arising from accident or trauma. C. Disfiguring disease, tumor, virus, or infection. D. Treatments covered by the National Health Insurance Program. 3. Sweetened beverages taxed at 6 pesos per liter. Exceptions. All milk products. B. 100% natural fruit juices. C. 100% natural vegetable juices. D. Meal replacement and medically indicated beverages. E. Ground coffee, instant soluble coffee, and pre-packed coffee. Documentary stamp tax. 1. All existing rates doubled except for 50% increase only. A. All debt instrument from 1 peso to 1.50 pesos or 200 pesos for fraction thereof. No changes. B. Policies of insurance upon property. C. Fidelity bonds and other insurance policies. D. Indemnity bonds. E. Deed of sale and conveyances of real property. Compliance requirement. 1. Annual sales, earnings, receipts, or output exceeding 3 million shall have their books of account examined and audited yearly by CPAs, and their income tax returns shall be accompanied by duly accomplished account information form. 2. Electronic sales reporting and invoicing, duly registered receipts or sales, or commercial invoices, prepared at least in duplicate, shall be issued for sales or services rendered valued at 100 pesos or more, formerly at 25 pesos only. Within 5 years from January 1st, 2018, the following shall be required to issue electronic receipts or sales or commercial invoices. A. Taxpayers engaged in export. B. Taxpayers engaged in e-commerce. C. Taxpayers under the jurisdiction of the large taxpayers service. Statutory offenses and penalties. 1. Interest is reduced from 20% per annum to double the legal interest rate, that is 6%. 2. Deficiency interest shall be assessed from the date prescribed for its payment or upon issuance of a notice in demand by the CIR, whichever comes earlier. 3. Deficiency and delinquency interest shall not be imposed simultaneously. 4. Increase in penalties. Attempt to evade or defeat tax, 500,000 to 10 million fine, 6 to 10 years of imprisonment. Unauthorized or illegal printing of receipts or invoices, 500,000 to 1 million fine, 6 to 10 years of imprisonment. New provisions. 5. Failure to transmit sales data entered on cash register machine or point of sales system machine to the BIR electronic sales reporting system. 6. Purchase, use, possession, sale or offer to sale, installation, transfer, updating or upgrading or maintaining suppression devices. 7. Offenses related to fuel marketing. 8. Deliberate failure to act on the application for refunds within the prescribed period under Section 112. Selected Supreme Court rulings on tax remedies under the NARC. So the purpose of the written notice requirement is to aid the taxpayers in making a reasonable protest, if necessary. Merely notifying the taxpayer of his or her tax liabilities without detail or particulars is not enough. Fitness by Design, GR 215-957, November 9, 2016. The issuance of a valid formal assessment is a substantive prerequisite for collection of taxes. The same case. Both Section 228 of the NIRC of 1997 and Section 3.1.4 of the RR 1299 clearly requires the written details on the nature, factual, and legal basis of the subject deficiency tax assessment. A void assessment bears no valid fruit. Summer 1, Electric Cooperative versus CIR, GR number 193100, December 10, 2014. The law requires that the legal and factual basis of the assessment be stated in the formal letter of demand and assessment notice. Thus, such cannot be presumed, otherwise the express provisions of Article 228 of the NIRC and RR 1299 would be rendered nugatory. The alleged factual basis in the advice, preliminary letter, and audit working papers did not suffice. There was no going around the mandate of the law that the legal and factual basis of the assessment be stated in writing in the formal letter of demand accompanying the assessment notice. CIR versus N1, Subic Power Corporation, GR 166387, January 1920. 09. Assessments are presumed correct and made in good faith. The taxpayer has the duty to proving otherwise. In the absence of proof of any irregularities in the performance of the official duties, an assessment will not be disturbed. Even an assessment based on estimates is prima facie valid and lawful where it does not appear to have been arrived at arbitrarily or capriciously. Marcus II versus Court of Appeals, year 12880, June 5, 1997. The burden of proof is on the taxpayer contesting the validity or correctness of an assessment to prove not only that the Commissioner of Internal Revenue is wrong, but the taxpayer is right. Otherwise, the presumption of correctness of tax assessment stands. Commissioner of Internal Revenue versus Hantex Trading Company, GR 136975, March 31st, 2005. Respondent had fully informed petitioner in writing of the factual and legal basis of the deficiency tax assessment, which enabled the latter to file an effective protest. Much unlike the taxpayer in N1, petitioner's right to due process was thus not violated. Summer First Electric Cooperative versus CIR, GR number 193100, December 10, 2014. To recapitulate, a decision differs from an assessment, and failure of the FDDA to state the facts and law on which it is based renders the decision void, but not necessarily the assessment. Tax laws may not be extended by implication beyond the clear import of their language, nor their operation enlarged so as to embrace matters not specifically provided. CIR versus Liquigas Phil Corporation, Liquigas Philippines versus CIR, GR 215534, April 18, 2016. The directive is in consonance with this court's dictum that the commissioner should always indicate to the taxpayer in clear and unequivocal language what constitutes his final determination of the disputed assessment. That procedure is demanded by the pressing need for fair play, regularity, and orderliness in administrative action. Advertising Associates Incorporated versus Court of Appeals, GR L 59758 of 1984, December 26. The Commissioner of Internal Revenue, CIR, as well as his duly authorized representative must indicate clearly and unequivocally to the taxpayer whether an action constitutes a final determination on a disputed assessment. Words must be carefully chosen in order to avoid any confusion that could adversely affect the rights and interests of the taxpayer. In the case of Allied Banking Corporation versus CIR, GR 175097, February 5, 2010, the Supreme Court said, "We have time and again reminded the CIR to indicate in a clear and unequivocal language whether his action on a disputed assessment constitutes his final determination thereon, in order for the taxpayer concerned to determine when his or her right to appeal to the tax court accrues. Viewed in the light of the foregoing, respondent is now stopped from claiming that he did not intend the formal letter of demand with assessment notices to be a final decision. But even as we concede the inevitability and indispensability of taxation, it is a requirement in all democratic regimes that it be exercised reasonably and in accordance with the prescribed procedure. If it is not, then the taxpayer has a right to complain, and the courts will then come to his succor. For all the awesome power of the tax collector, he may still be stopped in his tracks if the taxpayer can demonstrate that the law has not been observed." CIR versus BASF Coding and Inks, Philippines, GR 198677, November 26, 2014. The absence of an LOA violated Medicard's right to due process. An LOA is the authority given to the appropriate revenue officer assigned to perform assessment functions. It empowers or enables said revenue officer to examine the books of account and other accounting records of a taxpayer for the purpose of collecting the correct amount of tax. An LOA is premised on the fact that the examination of a taxpayer who has already filed his tax returns is a power that statutorily belongs only to the CIR himself or his duly authorized representatives. Medicard Philippines Incorporated versus CIR, GR 222743, April 5, 2017. Fraud is never imputed, and the courts never sustain findings of fraud upon circumstances which at most created only suspicion, and the mere understatement of a tax is not itself proof of fraud for the purpose of tax evasion. Utivo and Sons Hardware versus CTA, L13203, January 28, 1961, quoted in the case of Commissioner of Internal Revenue versus Melchor Javier and the CTA, with GR number 78953, July 35 of 1991. Without doubt, private respondent would be prejudiced by the retroactive application, as it would be assessed of deficiency excise tax. ABS-CBN Broadcasting Corporation versus Court of Tax Appeals, GR 52306, October 12, 1981. However, well entrenched is the rule that rulings and circulars, rules and regulations promulgated by the CIR would have no retroactive application if to so apply them would be prejudicial to the taxpayer. Without doubt, private respondent would be prejudiced by the retroactive application, as it would be assessed of deficiency excise tax. Commissioner of Internal Revenue versus Court of Appeals, Court of Tax Appeals, and Alhambra Industries, GR 117982. February 6, 1997. Waiver of the statute of limitations. A waiver of the statute of limitations under the NIRC to a certain extent is a derogation of the taxpayer's right to security against prolonged and unscrupulous investigations, and must therefore be carefully and strictly construed. The waiver of the statute of limitations is not a waiver of the right to invoke the defense of prescription as erroneously held by the Court of Appeals. It is an agreement between the taxpayer and the BIR that the period to issue an assessment and collect the taxes due is extended to a date certain. The waiver does not mean that the taxpayer relinquishes the right to invoke prescription unequivocally, particularly where the language of the document is unequivocal. Philippine Journalist versus CIR, GR 162852, December 16, 2004. Section 203 of the National Internal Revenue Code of the 1997 mandates the government to assess internal revenue taxes within 3 years from the last day prescribed by law for the filing of the tax return, or the actual date of filing of the return, whichever comes later. Hence, an assessment notice issued after the 3-year prescriptive period is no longer valid and effective. CIR versus Kudas Metal Corporation, GR 178087, May 5, 2010. Section 222, letter B of the NIRC provides that the period to assess and collect taxes may only be extended upon a written agreement between the CIR and the taxpayer, executed before the expiration of the 2-year period. CIR versus Kudas Metal Corporation, GR 178087, May 5, 2010. A perusal of the waivers executed by respondents' account reveals the following infirmities. 1. The waivers were executed without the notarized written authority of PASCO to sign the waiver in behalf of the respondent. 2. The waivers failed to indicate the date of acceptance. 3. The fact of receipt by the respondent of its filed copy was not indicated in the original copies of the waivers. Due to the defects in these waivers, the period to assess or collect taxes was not extended. Consequently, the assessment that were issued by the BIR beyond the 3-year period are void. CIR versus Kudas. On the other hand, the stringent requirement in RMO 2090 and RD 800501 are in place precisely because the BIR put them there. Yet, instead of strictly enforcing its provisions, the BIR defied the mandates of its very own issuances. Verily, if the BIR was truly determined to validly assess and collect taxes from respondent after the prescriptive period, it should have been prudent enough to make sure that all the requirements for the effectivity of the waivers were followed not only by its revenue officers, but also by respondent. First, the parties in this case are in pari delicto, or in equal fault. In pari delicto connotes that the two parties to a controversy are equally culpable or guilty, and they shall have no action against each other. However, although the parties are in pari delicto, the court may interfere and grant relief at the suit of one of them, where public policy requires its intervention, even though the result may be that a benefit will be derived from one party who is in equal guilt with the other. CIR versus Nextmobile, GR 21, 28, 25, December 7, 2015. We agree with the holding of the CTA and bank that ATC's case was similar to the case of the taxpayer involved in the CIR versus NextMobile. The foregoing defects noted in the waivers of ATC were not solely attributable to the CIR. Indeed, although RDA 0105 stated that the waiver should not be accepted by the concerned BIR office or official unless duly notarized, a careful reading of RDA 0105 indicates that the proper preparation for the waiver was primarily the responsibility of the taxpayer or its authorized representative signing the waiver. Such responsibility did not pertain to the BIR as the receiving party. Consequently, ATC was not correct in insisting that the act or omission giving rise to the defects of the waivers should be ascribed solely to the respondent CIR and her subordinates. Asian Transmission vs. CIR, GR 230861, September 19, 2018. Prescriptive period to assess and collect deficiency taxes. In all these cases, the request for reinvestigation of the assessment filed by the taxpayer was evidently granted, and actual reinvestigation was conducted by the BIR, which eventually resulted in the issuance of an amended assessment. On the basis of these facts, this court ruled in the same cases that the period between the request for reinvestigation and the revised assessment should be subtracted from the total prescriptive period for the assessment of the tax, and once the assessment had been reconsidered at the taxpayer's instance, the period for collection should begin to run from the date of the reconsidered or modified assessment. BPI vs. CIR, GR 139736, October 17, 2005. Cases on receipt of assessments and violation of due process. The Supreme Court has ruled that in the case of tax assessment, a mere direct denial made by the taxpayer is enough to rebut the disputable presumption provided under the aforequoted Section 3, letter V of Rule 131 of the Rules of Court. CIR vs. Metrostar Suprema, GR 185371, December 8, 2010, or Barcelona vs. CIR 157064, August 7, 2006. In civil cases, services made through registered mail is proved by the registry receipt issued by the mailing office and an affidavit of the person mailing of facts showing compliance with Section 7 of Rule 13, Rules of Procedure 1997, Ting v. Court of Appeals, GR 140665, November 13, 2000. When service of notice is an issue, the rule is that the person alleging that the notice was served must prove the fact of service. The burden of proving notice rests upon the party asserting its existence. In civil cases, service made through registered mail is proved by the registry receipt issued by the mailing office and an affidavit of the person mailing of facts showing compliance with Section 13 of the Rules of Civil Procedure. It cannot be stressed enough that it is the registry receipt issued by the mailing office and the affidavit of the person mailing which proves service made through registered mail. Absent one or the other, or worse, both, there is no proof of service. Republic of the Philippines versus Resins, GR 175891, January 12, 2010. An assessment is deemed made only when the collector of Internal Revenue releases, mails, or sends such notice to the taxpayer. CIR vs. Pascor Realty, GR 128315, June 29, 1995. To prove the fact of mailing, it is essential to present the registry receipt issued by the Bureau of Posts or the registry return card which would have been signed by the taxpayer or its authorized representative. CIR vs. GJM Fills Manufacturing, GR 202695, February 29, 2016. Pleadings filed through private courier. The date of filing is the date when the court received it. not the date when it was delivered to the courier agency. Bautista versus Bautista, GR 2020-88, March 8, 2017. To summarize, for the just disposition of the subject controversy, the rule is that from the date an administrative claims for excess unutilized VAT is filed, a taxpayer has 30 days within which to submit the documentary requirements sufficient to support his claim, unless given further extension by the CIR. Then upon filing by the taxpayer of his complete documents to support his application, or expiration of the period given, the CIR has 120 days within which to decide the claim for tax credit or refund. Should the taxpayer on the date of his filing manifest that he no longer wishes to submit any other additional documents to complete his administrative claim, the 120-day period allowed to the CIR begins to run from the date of filing. In all cases, whatever documents a taxpayer intends to file to support his claim must be completed within the 2-year period under Section 112, letter A of the NIRC. The 30-day period from denial of the claim or from the expiration of the 120-day period within which to appeal the denial or inaction of the CIR to the CDA must also be respected. Pilipinas Total Gas versus Commissioner of Internal Revenue, GR 207112, December 8, 2015. As a general rule, the 30-day period to appeal is both mandatory and jurisdictional. The only exception to the general rule is when BIR ruling number DA 489-03 was still in force, that is, between 10 December 2003 and 5 October 2010. The BIR ruling excused premature filing, declaring that the taxpayer claimant need not wait for the lapse of the 120-day period before it could seek judicial relief with the CTA by way of petition for review. A final note, the taxpayers are reminded that when the 120-day period lapses and there is inaction on the part of the CIR, they must no longer wait for it to come up with a decision thereafter. The CIR's inaction is a decision itself. It is already a denial of the refund claim. Thus, the taxpayer must file an appeal within 30 days from the lapse of the 120-day period. Brom, Apollo versus CIR, GR 168950, January 14, 2015. Corollarily, it is the governing principle in taxation that tax exemptions must be construed in strictissime juris against the taxpayer and liberally in favor of the taxing authority. And one who claims an exemption must be able to justify the same by the clearest grant of organic or statute law. Commissioner of Internal Revenue versus Isabella Cultural Corporation, TR 172231, February 12, 2007. The general rule of requiring adherence to the letter in construing statutes applies with particular strictness to tax laws, and provisions of a taxing act are not to be extended by implication. CIR versus Julieta Ariete, TR 164152, January 21, 2010. Well settled in this jurisdiction is the fact that action for tax refund, as in this case, are in the nature of a claim for exemption, and the law is construed in strictissime juris against the taxpayer. The pieces of evidence offered by the claimant are also strictissime scrutinized and must be duly proven. KEPCA, Philippines Corporation versus Commissioner of Internal Revenue, GR 179961, January 31st, 2011. Oh, before I continue, and before I forget, if you're not yet subscribed to my channel, go ahead and hit that subscribe button. It's free, and click that bell icon to get notified on my next audios. And please let those ads play. I sincerely appreciate it. Thanks. Indeed, a claim for tax refund may be based on a statute granting tax exemption or as Commissioner versus Fortune Tobacco Corporation would have it, the result of legislative grace. In such case, the claim is construed strictissimi juris against the taxpayer, meaning that the claim cannot be made to rest on vague inference. Where the rule of strict interpretation against the taxpayer is applicable as the claim for refund partakes the nature of the tax exemption, the claimant must show that he clearly falls under the exempting statute. On the other hand, a tax refund may be, as it usually is, predicted on tax refund provisions allowing a refund of erroneous or excess payment of tax. The return of what was erroneously paid is founded on the principle of solutio in debiti, a basic postulate that no one should unjustly enrich himself at the expense of another. The caveat against unjust enrichment covers the government, and as decisional law teaches, a claim for tax refund proper, as here, necessitates only the preponderance of evidence threshold like in any ordinary civil case. CIR versus Mirant, Pagbilao, GR 172-129. The principle of solutio in debiti should govern this case since the BIR received something that it was not entitled to. The government should not use technicalities to hold on to money that does not belong to it. Only a preponderance of evidence is needed to grant a claim for tax refund based on excess payment. Southern Philippines Power Corporation versus CIR, GR 1796, October 19, 2011. In cases where the 1997 NRC provides a specific period for action, the inaction of the Commissioner of Internal Revenue shall be deemed a denial. CIR versus San Roque Power Corporation, GR 187485, February 12, 2013.